Something is about to shock a lot of people who own gold and silver. And I mean shock them in the good way. The way that leaves the folks who sat it out staring at their screens, wondering how they missed something that was sitting in plain sight the whole time. It is not the gold price that is going to do the shocking. Gold has already done its work, quietly, steadily, in front of everyone. The shock is coming from the metal standing right next to it, the one nobody on the financial channels wants to talk about with any real conviction. If you are holding silver right now, or if you have been staring at silver and wondering whether you missed the boat, I want you to sit with me for the next few minutes, because there is a relationship between these two metals that the trading desks understand perfectly and count on you never noticing. Here is my one promise to you. By the end of this, you will understand exactly what the shock is, why it has been building for years, and why the people who profit from your confusion would rather you never do the simple piece of arithmetic I am about to walk you through. So let me give you the first real piece of it right now, up front, no games. There is a number that measures how many ounces of silver it takes to buy a single ounce of gold. That number has a long, long history, and for most of the recorded history of money, it sat in a narrow band, low, tight, sane. In our own founding law, when the young United States wrote its very first coinage act, the government fixed the value of silver to gold at close to 15 to 1. 15 ounces of silver for 1 ounce of gold. And they did not pull that out of thin air. They picked it because that was roughly where the natural ratio had lived, across centuries, across empires, across civilizations that mined and weighed and traded these two metals long before there was a New York or a London to set a price. Now, hold that number in your head, near 15 to 1, because today that ratio does not sit anywhere near 15. It has spent years stretched out to levels that would have looked absurd to the men who wrote that founding law. Levels that in the modern era have swung far above the old range, and in moments of genuine panic have blown out to extremes. And here is the whole thesis of this video in one sentence. When a stretched thing snaps back, the metal that got left behind does not walk to catch up. It runs. That run is the shock. Let me make sure you understand what the ratio actually is, because the big banks love to keep this fuzzy. It is not some exotic derivative. It is division. You take the price of gold, you divide it by the price of silver, and you get how many silver ounces equal 1 gold ounce. When that number is high, it means silver is cheap relative to gold. Historically cheap. Cheap in a way that has a gravitational pull, because these two metals have moved together for thousands of years, and they do not tend to stay divorced forever. When that number is low, it means silver has caught up, or gold has come back to earth. And the entire history of these two metals is the history of that number stretching and compressing, like a rubber band that someone keeps pulling and letting go. Think about what that founding ratio really tells you. Near 15 to 1 was not a policy fantasy. It was a reflection of how much silver came out of the ground for every ounce of gold, and how these metals were valued in the hand. For most of monetary history, silver was money you spent, and gold was money you saved, and they walked side by side at a ratio that stayed remarkably stable for a very long time. What we are living through now is not the normal state of things. What we are living through is the rubber band pulled about as far as it goes, and the financial media treating that stretched, abnormal, historically extreme condition as if it were just the weather. It is not the weather. It is a coiled spring, and you are being encouraged not to look at it. Now, why does silver run instead of walk when that spring releases? This is the part that separates people who understand these markets from people who just watch the ticker. Silver is a much smaller, thinner, tighter market than gold. Gold is enormous, deep, held in vaults by nations and banks, measured against the whole world's wealth. Silver is a fraction of that size, and a huge share of the silver dug up every year is not saved at all. It is used. It gets soldered into circuit boards, laid into solar panels in tiny, dispersed amounts, consumed in electronics and industry in quantities so small per unit that recycling it is often not worth the trouble. Gold is hoarded. Silver is burned. And that means when demand for silver as money suddenly wakes up, it is chasing a supply that is thinner than people assume, because a lot of the metal that was mined is simply gone, dispersed into a billion little devices. So you have a small market, a stretched ratio, and a structural condition underneath it that almost nobody in the mainstream will lay out plainly for you. The silver market has run a supply deficit for several years running. Year after year, the world has used more silver than it produced, drawing down the visible above-ground stockpiles to cover the gap. That is not a rumor, and it is not a forecast. It is the direction of the thing, sustained, multi-year. And when you put a multi-year shortage underneath a historically cheap metal in a thin market, you have built the exact conditions where a catch-up move does not creep. It detonates. Let me stop here for a moment, because this is the point where I owe you something more than analysis. If you are 55 or older, if you have worked your whole life and built up $100,000 or more inside a 401k or an IRA, then this is not a spectator sport for you. What happens to the value of paper savings and to the metals that have protected savings for 5,000 years is the difference between a retirement that holds and one that quietly erodes. So here is something worth knowing, and it is not just for insiders. The central banks, the most sophisticated buyers of gold on the planet, have been accumulating physical metal at a record pace, more than 1,000 tons a year for several years running, roughly double what they were buying the decade before. They are protecting themselves, and there is a perfectly legal, perfectly ordinary way for you to do the very same thing inside the retirement account you already have. You can move a portion of that account into physical gold and silver, real metal, without triggering taxes and without triggering penalties, through what is called a self-directed precious metals IRA. If you have 100,000 or more in any retirement account, this is available to you. The same protection the biggest institutions on earth are quietly buying for themselves. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and we will send you everything you need to understand how it works at no cost and with no obligation. All right, back to the arithmetic, because now I want to show you why this catch-up is not a hope. It is a pattern that has already played out in front of us more than once. Go back a few years to the panic that gripped the world in the spring of that terrible year, when everything sold off at once. Silver got crushed. It fell to a level that, looking back, was almost unbelievable, and the ratio, the gold to silver number, spiked to an extreme, a level far beyond anything the founders could have imagined. Silver so cheap against gold it looked broken. And then what happened? Over the following months, silver did not walk back. It ran. It outran gold, hard, and the ratio compressed violently, snapping back towards something more normal. The people who bought silver when it was historically cheap against gold did not need a miracle. They just needed the rubber band to do what rubber bands do. That is the mechanism. That is the whole shock in miniature. And here is the part the big banks are truly nervous about you understanding. That snapback was not a fluke of one crisis. It is the recurring behavior of two metals that have been tied together since before there were nations to tie them. The ratio stretches when fear and neglect push silver down and gold holds its ground. Then it compresses, sometimes gently, sometimes with a violence that leaves latecomers standing at the door. The stretch we have lived through has been long and wide. And a wide stretch is not a reason silver has failed. A wide stretch is stored energy. Now let me hit you with the part that almost nobody gets to, because this is where it stops being a chart and starts being about you and your money. When silver last truly caught fire, decades ago, it ran to a ceiling near $50. And then, roughly 31 years later, it came back and touched that same ceiling again, near 50, and got knocked down. 2 visits to the same wall, 3 decades apart. Now think about what that means. The base underneath that ceiling is around 45 years long. 45 years of a lid that silver has kissed twice and never broken through in a lasting way. Markets do not build 45-year bases so that nothing happens. The longer the coil, the bigger the eventual release. And here is the detail that should really make you sit up. That old high, adjusted for what a dollar is actually worth today, was never really 50 in the terms that matter. In today's money, it sits far higher, well into the low 3 figures, and silver has never reclaimed that real high. Not once. Not close. Everyone anchors to the number 50 because it is easy to remember. But the honest, inflation-adjusted truth is that silver in real terms is nowhere near its former peak. And that gap is exactly the kind of thing the financial media will never sit you down and explain. Why won't they explain it? Follow the incentives, because the incentives are the whole story. The trading desks and the big banks make their living on your churn, on your fear, on you selling into every shakeout and buying back higher. A frightened retiree dumping metal into a dip is their paying customer. And there is a mechanical piece to this too, one you should know about. In these paper markets, the exchanges can and do change the rules on the leveraged players. There was a moment not long ago when the margin requirements on silver were hiked hard, and silver fell around 30% in a matter of days, even though nothing about the actual metal, the actual supply, the actual demand had changed one bit. Nothing fundamental moved. Only the paper rules moved. That is worth burning into your memory because it tells you something profound. A price drop driven by a rule change on paper contracts is not the market telling you silver is worth less. It is the paper telling you the paper got squeezed. The metal in your hand did not get smaller. And if you want proof that these metals no longer behave the way the textbooks say, look at what gold itself has been doing. For decades, the rule was simple. When real interest rates rose, gold was supposed to fall because gold pays you nothing and higher yields make everything else look more attractive by comparison. That inverse relationship held for a very long time, and the financial channels leaned on it like gospel. Then, in recent years, it simply broke. Gold climbed even as real yields stayed stubbornly high, defying the old rule entirely. And the honest explanation is that the central bank and physical demand I told you about overwhelmed the textbook. The old relationship snapped. Now ask yourself a simple question. If the primary metal, gold, can quietly rewrite the rules the experts swore by, what makes anyone so confident that silver, the smaller and thinner of the two, is going to keep politely sitting under a ratio stretched to a historic extreme? The correlations that were supposed to hold have already stopped holding. That is your warning that the map everyone is using is out of date. And this is the difference that will matter most to you when the shock comes. There is silver, and there is paper that claims to be silver. When the catch-up move happens, when that stretched ratio finally compresses in earnest, the people holding real metal are in a completely different position than the people holding a promise on a screen. We have watched, in other corners of these markets, exchanges cancel completed trades when the paper lost to the metal. We have watched crowds try to squeeze a market by buying paper claims, only to fail, because buying a claim just tells the system to print another claim. Paper can be diluted. Paper can be remargined. Paper can have its rules rewritten overnight. An ounce of silver in your possession, or held for you as real allocated metal, cannot be conjured out of thin air, and it cannot be printed away. When the spring releases, you want to be holding the thing, not the promise of the thing. Let me re-anchor you, because I do not want you to walk away with a fantasy. I am not going to promise you a price, and I am not going to promise you a date. Anyone who does is selling you something. Silver is volatile. It can be gut-wrenching to hold. It can drop while gold sits still, and it can drop again after that. And the shakeouts are designed, whether by intent or by structure, to knock loose exactly the people who lack conviction. This is a case, not a guarantee, and it is not personal financial advice, but a case built on the oldest monetary relationship in human history, a ratio stretched to a historic extreme, sitting on top of a multi-year physical shortage in a market too thin to absorb a real awakening of demand, is a case worth understanding with both eyes open. So what do you actually do with this, as a practical matter, if you own silver or you are thinking about it? A few honest principles. Own the metal, not a paper claim on it, because when it matters most, the two behave nothing alike. Size your position so that a sharp drop, and there will be sharp drops, can never force you to sell. The people who get destroyed in silver are almost never the ones who are wrong about the direction. They are the ones who were right, but were positioned so aggressively that a shakeout forced their hand at the bottom. Do not be that person. And do not sell into the shakeout, because the shakeout is the entry ticket someone else is buying, while you are handing them yours. Position it so you can hold, and then hold. Now, here is the part I've been saving, the part that ties it all together, and that almost nobody will say to you plainly. Where are we in this story? We are not in the moment of recognition yet. That is the whole point, and it is precisely why this matters now. The smart money already sees it. The central banks are already buying gold hand over fist. The roster of nations quietly accumulating metal has been broadening, not shrinking. But the mainstream, the pension funds, the financial media, the neighbor at the barbecue, they have not caught on to the silver side of this at all. Silver is still the metal everyone left for dead. And by the time it becomes obvious, by the time the catch-up is leading every news segment and every advisor is finally recommending it, the easy part of the move will already be behind us. That is how these things always go. The recognition comes last, and it comes to the crowd all at once, after the people who understood the arithmetic were already positioned. Nobody is going to call you and tell you the moment has arrived. Nobody sends you an invitation to be early. You either did the division and understood the stretched ratio before the crowd, or you watched it on the news afterward and wished you had. So let me bring this all the way back to where we started, and let me be direct with the folks who stayed with me to the end, because you are the ones this last part is for. The shock in the title is not mysterious anymore. The shock is silver's catch-up. It is what happens when a ratio stretched far beyond the sane, centuries-old level our own founders wrote into law finally compresses, and the small, thin, deficit-ridden silver market has to reprice in a hurry against gold that already did its work. That is the whole thing. Near 15 to 1 was normal for most of monetary history. What we have now is the abnormal, the stretched, the coiled, and springs release. If you have $100,000 or more in a retirement account and you have watched this all the way through, I want to offer you something real. We hold a free one-on-one educational web conference for viewers in exactly your situation. No cost, no obligation. Just a clear-eyed walk through how to protect and position a portion of your retirement in physical gold and silver. Mention that you watched this all the way to the end. And here is the honest reason to do it now rather than someday. The window where a decision like this is still calm, still cheap, still fully reversible is exactly the window where nothing feels urgent, which is right now, before the crowd arrives and the easy part is gone. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffweedguide.com. Do the arithmetic the big banks are hoping you never do. Understand the stretch and make your decision while it is still quiet. Because the shock is coming for everyone, and the only question is whether it minds you already holding or watching from the outside, wishing you had moved while the getting was good.